What's that say?
302, distributions and redemption of stock. If a corporation redeems its stock,
Hold on, what's a redemption?
when a business buys back their stock.
Business buys back stock. Okay? 302 is what we were talking about at the very beginning about the bailing out of EMP. Okay? There's 302. 302 B1, 302 B2, and 302 B3. Okay? And these, Trent, are we doctors?
No,
But what do we do?
diagnose.
Okay? So 302 is what we use to diagnose what the characterization is when there's a redemption. And the redemption is a legal act of the corporation buying back its own stock. So 302 is the provision that helps us diagnose. 302B1 says substantially not a dividend. Okay? Jack, what does that mean?
I don't know.
Guess what? I don't either.
Okay.
Okay? And a friend of mine, I call him and I say, I don't understand what this means. And every time he explains it. And I go, yeah, I get it this time. And 2 minutes later, it's like I've smoked as much marijuana as possible and I can't remember it. I cannot remember what substantially not a dividend is. I've used it as a fallback position when nothing else has worked. But I don't really know what it means. So we're not going to worry about it. 302B2 is a mechanical safe harbor. And 302B3 is 100% redemption. With an election out of Code Section 318. What does that mean? We'll come to it. Okay? So, one, as I said, was redemption not equivalent to a dividend. Subsection A shall not apply if redemption is not necessarily equivalent to a dividend. Now you know everything I know about 302B1. 302B2 is a mechanical safe harbor. The mechanical safe harbor says, let's see, I'm going to try to do this from memory, and I can tell you that I'm going to do it incorrectly because I always forget a nuance. There's a piece of this that I have a hard time wrapping my head around that I have to go back and look at my grad school notes, but this is going to be more than directionally correct. What I'm going to tell you, I'm telling you is slightly wrong, and I can't remember exactly how it's slightly wrong, so we're going to go with it and understand it's slightly wrong, and if you confront this, then you should come to my office and we'll look up the real rule, okay? Mechanical safe harbor it's a two-prong test, okay? First prong test is, does the shareholder percent owned, is it less than 50% post sale? That's the first prong. So why is that important? Or why is that rule in place? If I have a corporation and I want to do a bailout of EMP, like we were talking about earlier, that $700 that we were talking about earlier, and I own 100% of the company, or excuse me, I own 90% of the company, and we do a redemption, and at the end, I own 51% of the company, am I still in control? Yes. So let's back up. What I mean by what we're diagnosing. If you will come over here to result. you have one or two. If you fail 302, there's one result. If you pass 302, there's another result. So if you fail 302, that means that you're playing some shenanigans. And you diagnose the redemption as a distribution. If you pass 302, meaning you aren't playing shenanigans, then it's sale or exchange of stock. Okay, so that's what you're doing in the diagnosis under 302. Is it a sale or exchange of stock, or is it a distribution from the company? So if you fail, distribution. If you pass, sale or exchange. So over here, if the shareholder has less than 50% after the redemption, they passed the first part of the mechanical safe harbor. And we are on our way, since we're on our way to passing, we're on our way to treatment of sale or exchange. So the second test is you have to have a 20% reduction in your ownership as compared to pre-ownership percentage. So if I have 40% ownership pre, that means 20%, I have to have an 8% reduction in my shares. I think. This is the piece I can never remember. There's this 80%, 20%, but so the rule we're going to use for purposes today, and again, I should have looked this up because again, I forget it every time, is 80% pre-ownership. So if it's less than, if post is less than 80% pre-ownership, you pass for purposes of today. I know that's not right. There's something that's nuanced in that rule that I can't remember off the top of my head. But that's close enough. So if I have a person with 55% ownership, and we go down to 49% post for ownership, well, did I go below 50%? I did, so I passed the first part of the test. What's 55%? I don't know if I pass or fail. 55 times 0.8 would be 44%. So my post percentage is 44%, which is less than the 49% it was before. Something along those lines, so it passes. I guarantee what I just told you was absolutely wrong on that second piece. I can't remember the rule. Can't remember it, but it's close. So you have those two prongs of the test in order to figure out whether you pass or fail the mechanical safe harbor. In this case, I'm saying we passed, therefore it's sale exchange. If we didn't pass, it'd be distribution. The last one is redemption, or excuse me, 100% sale of an interest. So that last piece, election out of 318, so you might want to take that, did you write that down as part of the options? Highlight that. Because that piece is wildly important in your analysis. Because 318 is a attribution provision for a related party. So, stupid question. If, I'll go over here. Well, Ben's not here anymore, who cares? Oh, we got rid of Ansel's. What 318 says is your measurement for the safe harbor is direct and indirect ownership. So if I have X, I have Pete, and I have JD. JD, are we related?
No.
Okay. So, and there's 50 shares that each of us own. Since we're not related, you don't have to worry about 318. I don't have to worry about JD's shares in my calculation at all. But if this is my wife, are we related? We are. So the direct and indirect ownership, under the analysis when I was looking at me and JD, my direct ownership was 50, my indirect was 0. Under husband and wife, or father-child, or whatever, I have 50 direct and 50 indirect. I'm deemed to own my child's shares. So even if I go down to 0, my percentage ownership, I have 50 direct, 50 indirect. I owned 100%, 100 shares. The population of shares outstanding is 100. I own both directly and indirectly 100%. In this case, if I redeem out all 50 shares, there's 0 shares owned direct, 50 shares owned indirect. The population of shares outstanding is 50. I still own 100%. There's no way to pass the mechanical safe harbor under that scenario. And 318 is always on unless it's turned off, I think. I think that's the reverse. I can't remember. Doesn't matter. So what this says is 302B3 says 100% redemption. So in that case, under B3, I have 100%. I've been redeemed out 100%. I can elect to turn off the application of the related party rules under B3, which means that my direct shares went from 50 to 0, and I have no indirect shares because I elected to turn it off. But in exchange for that election to turn it off, I have to agree to a couple things. And you see this in redemptions a lot, because Lutz has how many family-owned businesses? A lot. And how many generations, Gen 1 go to Gen 2 to Gen 3? And how many times do you see Gen 1 being redeemed out of the company? A lot. It's not 0. So the question is, what is it that I'm exchanging? What am I agreeing to by saying 318 or related party rules don't apply? And what I'm agreeing to is, I wonder if I have it marked in here. It's here somewhere. I'm going to go off. I'm going to go, oh, well, I wonder what the hell I wrote here. Okay, so I'm sure we're going to cover it again, as I've got it written, I'm sure. And we'll see if I'm right. We'll see how my memory is. I have to agree, in exchange for turn off 318, I have to agree to 1, no ownership for 10 years. No employment for 10 years. No board membership, 10 years. It seems like that's all of them, I think. But you can be a lender to the corporation. So if you want sale or exchange treatment to apply, if you want to pass 302B3 and you have related party issues, you can turn off the related party rules by agreeing to no ownership, no employment, no board membership. You have to sever ties with the company for a period of 10 years. That's what you have to agree to. And you see that a lot, okay. JD, what's number one since you've been answering this question all day?
What is a redemption? It's when a corporation buys its own stock from its shareholders.
You know what? I actually wonder if I remembered to put my math in here correctly. I bet I did. We'll see. And that'll bring clarity to whatever my 80% rule was. Okay? So pre-transaction, post-transaction, why does it exist? JD, why does it exist?
And it, sec. Do you just want me to read A and B, or?
Well, in the year
Where's that?
2000, who was alive in the year 2000? Is there anybody not alive in the year 2000? Got two. Why is that funny, Lane? I think you called me old, really old, by doing that. Is that what just happened?
2001. Yep. I'm 22.
Okay. So in the year 2000, do you know what the dividend rate was? It was equal to the ordinary tax rate. It was not equal to capital gains rate. So there was very high incentive to try to figure out how to get money out of a corporation and have a dividend bailout. Capital gains rates were 20. So this goes back to the example I talked about earlier that said, well, if I can get sale or exchange treatment on $1 million, it's $200,000 of tax. If it's dividend, it's $400,000. So if somebody does a cross purchase on the box at the bottom left of the page, I get cap gains treatment because I sold the stock. But if I do $1 million dividend, it's 40. But if Pete owns 100% of the company and he redeems shares, it looks like a sale or exchange. But really it's not, it's a dividend bailout. And these rules tell you that it's going to be treated as a dividend. Why does 302 exist? Basically got that. Okay. Essentially not a dividend. This says I'm not sure what that means, which we've covered that. But all right, so here we go. I'm glad I have this because I actually think I did look this up because it confuses me every damn time. 302B2. JD, who you want to call him? Because we're going to work through this math together because I can never remember it.
Tatum.
Who?
Tatum.
Tatum?
Yay.
Okay. I said that there's a two-prong test, right? Before. So what's prong one?
The taxpayer owns less than 50% of the company immediately after the redemption.
Okay. I got that one, don't I?
Yeah.
Over there. So what's prong two say?
Post-ownership percentage is less than 80% of the pre-ownership percentage.
Okay. I think I might have said that the first time. I think I did. Okay, so Pete owns 60 shares, Jeff owns 40. Exco redeems 30 shares of Pete's shares. Do I have a good mechanical safe harbor? Tatum, do I?
Yeah.
Okay, so prong one, how much do I own of the company after?
So the 43%,
How did you arrive at the 43%?
the 30 divided by 70.
Okay, so 30 shares, I have 30 shares remaining, correct? Mm-hmm. There were 100 to start with. So 70 were redeemed, so they're taken out of circulation.
Okay.
So it's 30 divided by the 70. Does that make sense to everybody?
Can you say that again?
Okay, so the starting shares between Pete and Jeff owns 40 shares, Pete owns 60. So the total population of shares outstanding is how much? 30 shares were redeemed from Pete. So my population of shares, Jeff still has 40, Pete has 30. So my population of shares shrunk from 100 down to 70. So now you have to take Pete's shares post-ownership, which is 30, divided by the revised post-ownership shares of 70. And how much was that, Tatum?
43%.
43%. So now I've quantified that percentage post-ownership is 43% more or less than 50%?
Less.
Less. So did I pass or fail the first prong? I pass, okay? So now we get to move on to the second prong. And the second prong says what, Tatum?
Post-ownership percentage is less than pre-ownership percentage times 80%.
Okay. So what's my post-ownership percentage?
The 43% has to be less than 80% times the pre-ownership percent, which is 60%. 60
Okay.
over 100.
So 43% is less than 48%.
Right.
So
it passes.
I could not articulate that 5 minutes ago. Because I have trouble remembering the rule. I cannot, it doesn't stick with me. I just know it's 80% of something and it all kind of works and I have to look it up every damn time. So I pass. Since I pass, it's distribution, right, Tatum?
No.
No, what is it?
Sale or exchange of stock.
Tatum gets a gift card. She didn't fall into a trap. Yeah. You were actually paying attention, right? And
Yes.
no, I mean, that didn't mean that disparagingly. That
Thank
sounded
you.
disparaging, but it was not. You were tracking, you understood, you would process the data and go, no, he's just screwing with me. And I was. Okay? So, 302B3 is complete redemption where they own it 80% or 0%. Mechanical safe harbor. Redemption, do related parties rule apply? 302B2, mechanical safe harbor, related rules apply. 302B3, they don't apply if you turn them off. Okay, so this is what we were talking about earlier. Related party rules under 302B2 under IRC 318 apply, ensuring ownership under 302C1. I don't even know what the fuck that means. Increasing, is that what that says? Measuring, thank you. I'm like, I don't even read my own damn handwriting. Related party rules under 318 apply measuring the ownership under 302C1, which that's 302C1 is the one that talks about 318. So dad and son, dad gets fully redeemed, son has shares, dad has 100% pre, didn't 100% after, even though it's indirect ownership. It's more than 50%, that's fail. And the prong says 100% post compared to 80%, fail. So by virtue of related party rules, 302B2, if you have related parties, you aren't getting out of it if you have any ownership. Or enough ownership that's related. All right, so 302B3, they do not apply if. Let's see how I did. Thomas, what's that say? What's this say in terms of how I get out of it? I like out of.
Are where are you at? Oh, number one, the redeemed shareholder has no interest in the corporation other than as a creditor. Or two, the redeemed shareholder can't acquire an interest other than by gift or inheritance in the corporation for a period of 10 years. The redeemed shareholder can't be an officer, director, or employee of the corporation for a period of 10 years.
How did I do?
Can you not own it for 10 years?
Only by gift or inheritance. You have to be out of the company for a period of 10 years in order to turn off the rules.
Do people do this a lot?
I've used this to get out of distribution rules and sit and get into sale or exchange. And I've used it to get into distribution and out of sale or exchange.
You use it a lot.
It's not uncommon.
That's a long time.
10 years?
Yeah.
Well, the IRS doesn't want to, 10 years is, you need to be sincere in your action. That's the point of 10 years. Under the built-in gains tax, it used to be you couldn't sell corporate assets that existed at the date of conversion for a period of 10 years because the IRS wanted you to be sincere in your conversion to S status. And now that they back that down to 5 years, but they still want you to be sincere in your move into S status.
Pete,
Yeah.
nowadays, why would you want to get out of a distribution and into a seller exchange?
What, when, or why?
Yes.
What are the fact patterns? Okay, Ansel's asking me a question. Now I got to answer the question. Okay? So let's say, restate your question, Ansel, just so everybody understands.
When would you want it to be a seller exchange rather than a distribution?
Or why also.
Okay? So let's take 2 fact patterns. Okay? I have C1, C Corp. And I have S1, S Co. And I'm going to make this dad and son. I'm going to make this dad and son. And I'm going to say that EMP over here is 10 million. And I'm going to say AAA over here is 10 million. And we're going to cover AAA. And so what the hell is AAA? Just as an insight for the youngsters in the room, what is it? Let's see if you remember. You said the best part was
I know.
distributions.
I'm trying. Like, I remember the rules there. I'm just trying to think what AAA exactly is. Like, I mean, it's an S corp's undistributed earnings, almost.
That was exactly right. AAA is earnings that have been earned by the S Corp that are undistributed. And that concept is going to be wildly important for which section, Ansel? Distributions. Okay? And I'm going to say that dad's basis over here is 5 million. And son's basis is 5 million. There's no inside-outside basis problem. And over here, we'll say basis is 10K and 10K. Because in a C Corp, basis is not adjusted for the earnings of the company. The S Corp it is. Right? So, dad wants out. He wants to ride off in the sunset and just leave it to the next generation. So, hold on, let me give you one other fact pattern. Fair market value is 20 million. Fair market value is 20 million. It's 50-50. How much is dad worth? Jameson,
20 million.
how much is dad worth in a 50-50 relationship?
I thought you.
No, the whole entity. The whole entity is worth 20 million. And dad owns 50%.
10 million.
10 million. Okay? So, we say we're going to redeem dad out. Okay? And we're going to take 100%, we're going to take and buy back dad's shares at 100%. Okay? And we give him, let's call it 5 million of cash in redemption and a $5 million note. Okay? And over here, same thing. We give dad 5 million of cash and a $5 million note. So everything's equal so far, right? The fact patterns are equal on both sides. So going back to if we redeem 100% of dad out, and we don't turn off 318 or the related party rules, how much does dad own post?
100%.
100%. So do we fail 302? And if we fail 302, what is it?
Distribution.
So now we got a distribution. So let's look at the distribution for a second. Okay? If we come over here and we have $1 million of C, E, and P in the corporation and its distribution, and we distribute 10 million out, what is that? It's a dividend. So if it's a dividend, Dad doesn't get to use any of his basis. So Dad has a $10 million dividend, no basis coverage, and he's screwed. So Dad's going to elect to say, oh, no. I'm not going to be in the business for a period of 10 years. I'm not going to be on the board of directors. I'm just going to stay out of the affairs, and I want Sailor Exchange treatment. So I'm going to elect 318 not to apply to the shares. In exchange, I'm going to stay out of the business. So now instead of having a $10 million income event, hey, let me change my basis. That's a little too stark. Let's make it $1 million, a basis. Dad's going to have, instead of 10 million of income, he's going to have 9 million of income because he gets to use his basis because it's Sailor Exchange. So in that case, you would want to turn off the distribution rules and make it Sailor Exchange. Now, over here on S Corp, well, that's a different story. Because if, even though we've had a Sailor Exchange, if we have a Sailor Exchange, let's say that Dad turns it off. We have Sailor Exchange. We have 10 million of proceeds, and we have 5 of basis. That means the first 5 million that we get, gross profit percentage is 50%, 2.5 million is going to be taxed today when I receive that 5 million. But if I don't turn off the related party, well, I own 100% after indirectly. So I'm not in Sailor Exchange rules, I'm in distribution rules. So the 5 million that comes out on day one is a return of basis. And I don't have any tax liability when the 5 million comes out. So it depends. The answer is my favorite answer, it depends. What's your fact pattern? You know, we're not here to be what, Thomas?
Experts.
But we're here to learn something. And this is worth knowing. And 302, to me, is a really, really good provision to know, but it's hard. It's hard to remember all the moving pieces of 302. But anytime you have a redemption, which is what, JD?
Business buying back their stock.
Business buying back their stock. You need to come see me so we can do what, Trent? Diagnose whether we want it to be a distribution or Sailor Exchange and what's more advantageous. Yeah.
Can you go through the facts one more time? I don't get where the 9 or like the million in basis, or where's the basis at?
The basis is, I changed it to $1 million a basis for Dad. Okay, so Jameson, if we didn't turn off the related party rules, it's going to be a distribution.
Yes.
Okay, and there's $10 million worth of EMP in the company. So that $10 million of EMP in the company, since it's a distribution, is now going to be a dividend to Dad of $10 million. Bad. Okay, but if we turn off the related party rules and we get to Sailor Exchange, at that point, what's my definition of proceeds, Jameson?
Property, cash, debt relief.
Property, cash, and debt relief. So my cash, or my property, was a note receivable of $5 million. Cash was $5 million. Total proceeds, $10 million. Basis, $1 million. $9 million of gain. And now we're on the installment basis because we're not going to be able to receive the full proceeds. So on the 5, instead of having 10 million of income right out of the chute, I have 4.5 million because my gross profit percentage is 90% or whatever that number is. So in that case, we want that to be Sailor Exchange because we want to be able to do 2 things. Utilize our basis against the amount coming out and have it treated as an installment sale. Yeah?
So what's the rule to be treated as an installment sale? Just not getting all cash?
Okay? Now we're on to a different topic. Okay, installment sale means that transaction 1231, 1231. Okay? You have a transaction date 1231, 1231. And I'm going to pretend, Jameson, that we have total proceeds of $9 million. Okay? And on transaction date, we receive a note for $9 million. Okay? So cash, property, debt relief, total proceeds, $9 million. We've run through my favorite provision. My basis in that is $4.5 million. What's my total gain, Jameson?
4.5?
4.5. Okay? So that is the total gain that I have the opportunity or obligation to report on a tax return. However, the $9 million is going to be received $3 million at close, $3 million the next year, and $3 million the next year. I have a payment stream that is being paid out over with respect to that $9 million. So, would it be fair to have me report all $4.5 million gain in year one if I haven't received all the cash? No. So what they do is say, calculate your total gain associated with the transaction. Then come up with a gross profit percentage associated with that transaction. So you take gross profit percentage is gain divided by proceeds. My gain is what? 4.5. My total proceeds is 9. What's my gross profit percentage?
2%?
50%. So now, once you have your gross profit percentage, you have to apply that gross profit percentage to the cash we received. So, 3 million times 50%, 1.5. 3 million times 50%, 1.5. 3 million times 50%, 1.5. I have 1.5 of recognition that I'm taxed on in year transaction, 1.5 in year one, and 1.5 in year two. What's 1.5 plus 1.5 plus 1.5? 4.5, which comes back to the total gain that existed when we did the transaction. So over here, we have the installment to say, hey, total proceeds is 10, basis of 1, 9 million gain, gross profit percentage is 9 million gain divided by total proceeds 10, 90% gross profit percentage. I receive $5 million of cash. 5 million cash times 90% is 4.5 million. So when I receive the next 4.5 million or 5 million times 90%, that's when I'll have to report that gain. But if I don't turn off the related party provision, I got a $10 million dividend. That's a problem. So, but for distribution, guess what you want to have? I mean, S Corp. You want it to be distribution because it depletes basis first. Did that satisfactorily answer your question, Ansel? No. Look at me, I do this shit all the time. This actually is probably a pretty handy page to. This is my version of whatever this was over here on some level. It's just probably a little neater and cleaner. 302, two possible outcomes, sale or exchange of stock or distribution. And then on one side I have shares are recognized as sold as capital gain. And then I have S Corp, shareholder sale or exchange treatment, C Corp, proportional reduction in AAA, and CEMP. C Corp, shareholder sale or exchange. Oh, now I know what the hell I'm doing on that last part. So let me tell you what I'm doing. So, sailor exchange treatment, and take whatever notes because this probably is worthy of expanding on some level. On the sailor exchange treatment side of the ledger here, you have an S Corp bucket and you have a C Corp bucket. And the sailor exchange treatment for S Corps and C Corps is going to have its own result. The sailor exchange treatment for shareholder under the S Corp side of things, and the sailor exchange treatment under the C Corp side of things, those are exactly the same thing. It's sailor exchange, and if we have an installment transaction, we're going to have the gross profit percentage, and we have to go through through that process. They're exactly the same on both sides. Okay, but for the corporate level, if it's sailor exchange, then you have a proportional reduction in AAA, which AAA was defined as what, Ansel?
Undistributed.
S Corp earnings, and C Corp earnings and profits. Okay? For C Corp, it's just proportional reduction in C Corp earnings and profits. So let's go back over here. Okay? What this is saying, what that rule is saying, is that how much E&P, Lane, did this have? Pre-transaction.
10 million.
10 million. We got sailor exchange treatment because we turned off the related party rules. And we agreed we weren't going to participate in the company, right? So how much of the company was redeemed? How much did Dad own?
1 million.
No, it's percentage ownership.
100.
50%.
Oh,
Yeah, exactly. That 50%, that pesky 50% number. So when the shares are redeemed in a C Corp, they say how many shares were retired in the redemption? 50% of them. 50% of the E&P goes away. Okay? And what this is saying over here with respect to S Corps, 50% of the shares were redeemed, 50% of the AAA goes away. And what we'll learn is if this S Corp was a C Corp at some point, and it had 10, we'll change this to say this has 10 million, not only 10 million of AAA, but 10 million of E&P, because E&P carries over when you convert to S Corp. 50% of the redemption is going to retire 50% of the AAA and 50% of the E&P. That's what that says for Corp circumstance or Corp consequence under the S Corp side up there. Okay, so then we have the distribution from the Corp. Shares not recognized as sold in the transaction is treated as distribution. S Corp side, we have distributions under 1368. Those are fun, aren't they, Ansel?
Mm-hmm.
Okay. Corp reduces AAA and potentially CEMP. Potentially, we'll run through those. 1368B and 1368B and 1368C are the rules that we're going to run through there. For a C Corp, the shareholder is going to be, when you have a distribution out of a corporation, you have three prongs, and this is under 301. 301 says when you have a distribution out of a C Corp from a C Corp, it's going to be prong number one, a dividend to the extent the C Corp has earnings and profits. So if we come back over to our example, we have 10 million of earnings and profits. C1 says the first 10 million is going to be treated as a dividend out to the shareholder. So our basis number, we might as well do this while we're at it. Our basis was how much, Lane? $1 million. Okay. So we got C1. Let's say that we have total distribution of 12 million. Okay? And it's only and Dad's the only guy in this case. There's distribution of 12 million. First step is dividend to the extent of earnings and profits. earnings profits of the company is $10 million. So C1 is $10 million dividend. C2 is return of basis. How much basis do we have, Tatum?
Million.
$1 million. So the next million, I've accounted for 12 or 10, right? We have 12 total. I accounted for 10 in C1. So there's 2 left that's unaccounted for. So C2 says $1 million of basis. So we have $1 million of basis under C2. That means that's not taxable. You're just getting your money back for what you put into the company. So then C3 is distribution in excess basis equals cap gain. And that's $1 million. So we started with 12 million of distribution. 10 million is going to be accounted for and sent out to the shareholders as a dividend. $1 million is not taxable, return of basis. And the last $1 million is going to be a gain or loss on the sale or exchange of stock. So that's what this is telling you here. Dividend, basis, and distribution in excess. That's 301, C1, C2, and C3. And then you have a direct reduction in CEMP for the dividend. And then that is what it is. That piece is relatively easy. So this is a better explanation of what that is. Oh, shit. Look, there's C1, C2, and C3. Okay. Ansel? Never mind. I was going to be a dick, but... No, I think I'm going to go back to being a dick. So C1, C2, and C3 is what we just talked about for C Corps. So distributions out of an S Corp, and we're really going to hammer on this. I'm now no longer going to be a dick. This has been quite a roller coaster. You have S Corps with CEMP, and you have S Corps that don't have CEMP. So once you make it through, whether we have a distribution or a sale or exchange, or whether it's a distribution, who cares? Distribution or redemption characterized distribution, don't care. But you got to run through these distribution rules. And what these distribution rules say, 302, I want to start with B1 and B2. Okay, everybody in the room probably on some level is familiar with 1368 B1 and B2. And what 1368 B1 and B2 says, when you receive cash from the S corporation, that's going to be a reduction of the basis in your stock. That seems familiar to everybody, I presume. Okay? If you have a distribution that's in excess of basis, then it's going to be a deemed sale or exchange of stock. I think that's familiar with everybody in the room. Maybe. Okay? However, now you're going to go to the other side, S Corp with CEMP. Now you have 1368 C1, 1368 C2, and 1368 C3. What 1368 C1 says, to the extent the corporation has AAA, and by the way, we're going to cover this, right? We're going to hammer on this. To the extent the company has AAA, and Ansel, what is AAA?
S Corp EMP.
Undistributed S Corp earnings and profits, earnings. Okay? To the extent the company has undistributed earnings that made while it's an S Corp, you get to refer back to your normal rules under B1, B2. Return to basis, distribution in excess. Once you run through your AAA, you no longer have any undistributed earnings from the S Corp. Then it says, well, wait a minute. You're making a distribution. You converted from C Corp to S Corp, and you have $10 million of EMP. So since you no longer have AAA, the next dollar distribution above AAA is going to be a dividend. That's C2. Then it says, once you've blown through your EMP, C3 says go back to your normal distribution rules. And we're going to hammer on this pretty hard. So this page actually has some significance in knowing something, maybe. Jesus, okay. All right. We're going to do this one last thing, and if I get through it quick, it's going to be beer 30. And we're going to just let you go. I think I've traumatized you guys enough. So, do you remember earlier I talked about 1001? And why I thought 1001 was important? Why was that, Jameson?
For the sailor exchange in the definition of proceeds.
Definition of proceeds, but not only that, 1001 is going to apply to all these code sections, and 311 is one of them. You have to put your sailor exchange hat on to what, Trent? Diagnose what's going on, right? So, and this provision just cracks me up. I think this is, the way they wrote this is, I think, catastrophically stupid. Catastrophically stupid is a little strong. It's just stupid. Okay? You have X, you have land, fair market value, 10,000, basis, 1,000. That's number one. Number two, you have 10,000 fair market value, 20,000 a basis. Two scenarios. Okay, so we understand there's one piece of land, and we're going to analyze it under two lenses. Lucas, what's 311A say?
A, general rule, except as provided in subsection B, no gain or loss shall be recognized to a corporation on the distribution, not in complete liquidation with respect to its stock of 1, its stock or rights to acquire its stock, or 2, property.
Stop. Okay, so in your book, you might want to highlight the section that says not in complete liquidation and put a little reference in not in complete liquidation is pointing you to code section 336. Because in complete liquidation is 336, and 336 is the corporate consequence of complete liquidation of the company. Okay, so that's thing one. And it says no gain or loss. Right, Lucas?
It does say that, yeah.
It does say that. So what that's saying is if you had the distribution, how much gain is inherent in scenario 1?
9,000.
9,000. How much loss is inherent in scenario 2?
10,000.
10,000. So if I, under A, I distribute land 1, does X experience any gain or loss?
It seems to say no.
It seems to say no. If I distribute 2, does X experience or report a loss?
Still no.
Okay. So let's read B. What's B say?
Distributions of appreciated property. In general, if a corporation distributes property other than an obligation of such corporation to a shareholder in a distribution to which subpart A applies, and B, the fair market value of such property exceeds its adjusted basis in the hands of the distributing corporation, then gain shall be recognized to the distributing corporation as if such property were sold to the distributee at its fair market value.
So sold to the distributed fair market value, that's where 1001 comes in. So what A says is no gain or loss is going to be recognized by the distributing corporation of the property coming out. And then B, this is why I think this is stupid, says no. We're going to hold on the loss. That's true. But if it's appreciated, then the corporation is going to be deemed to have sold that property and experience a gain. So if we distribute under scenario 1, does X have an obligation to report the $9,000 gain and go through the 1001 treatment?
Yeah.
It does. But if we distribute property under scenario 2, do I get to report the loss? No. Okay, so 311 is solely dealing with appreciated property. And how often do I see that? Something more than 0. Lucas, who you want to call in?
Haley.
Kaylee, what's this say? What's number 1 say?
Distribution of property from a corporation generally results in a taxable gain, but it will not result in a loss.
Assume Exco, go ahead.
Assume Exco is an S corporation that has the following balance sheet from a tax basis and fair market value. He owns Exco and has basis of 10,000.
Yep.
We've got assets. Lot A has basis of 10,000 and fair market value of 100, and Lot B has basis of 100 and fair market value of 10.
Okay. So what happens if we distribute Lot A? What's 311 say?
Hypothetical, or was the rest?
You want to call on somebody? Jameson, what happens if we distribute Lot A?
Taxable gain.
Why?
Because
311 says so. I'll accept that as an answer. How much is taxable gain?
90.
90. So that 90 then gets reported on what?
K1.
K1. So that K1 is issued to who?
Pete.
Pete. So we started with how much basis?
10.
And what was the K1?
90.
What's my revised basis?
100.
100. So now we also, though, this is where all the moving pieces come in. This is where this gets hard. Because 311 says you're going to have a gain or loss. All right, that's great. But then you have to go, well, that's getting reported on a K1. And then you have to say, well, that's revising the basis that I have in my shares. All those are things that are normal course, but stringing them all together is difficult. So now I have a revised basis of 100. Then what happens, Jameson?
They distribute it out.
Yep. So my beginning basis was 10, income 90, fair value of the property was 100,000. My ending basis was 0. Who you want to call on for the next one?
Thomas.
Thomas? What's B?
We don't have a gain or loss.
You have a loss of 90, but an M1 to take it out of 90, so you have 0 income. So then step 2 is you got to revise Pete's K basis because of the K1, correct? So we start with 0 income and a distribution of 10. Distribution of 10. So my beginning basis was 10, my income was 0, distribution was 10, which is equal to the fair value of the asset, 0 basis at the end. But that property had a $100,000 basis to begin with, right? How do we feel? Where'd the basis go? We had 100.
I just went away with the loss.
It went away. It's called disappearing basis. It disappeared, never to be seen again.
That's actually,
Disappearing basis? Yeah, and actually, when we talk about when we're going to do liquidations, and it's coming up, Lane, we're going to be doing taxable and tax deferred.
not
What was that little
scarred.
scarred? Why are you
A
scarred?
couple hours ago. I'm just kidding.
So under the tax deferred, the concept of disappearing basis exists. You'll see it again
It
there.
just goes away.
Goes away.
So they don't let you take the loss, and they
take away your.
increase your basis, so then when you sell it, you have more gain.
Yeah.
So they get you twice.
Yeah. The world's full of injustices.
This doesn't make any sense. It just disappears.
Usually they like increase it to help you out later.
Yeah, the IRS is a benevolent organization. So, all right, so oh, corporate liquidation. Okay, you deserve this because you asked the question. Because what was the next topic? What's at the top of the next page?
Corporate liquidation.
What did I say was going to happen?
That we could leave.
Not now, because you asked the question. Okay. Code section 267. This is a related party rule. And actually, this really is worth knowing. Jameson is crying foul on the injustice of the disappearing basis. Are you not?
Yep.
Okay. So what happens if the fair market value was how much? 10K? Basis was 100K? That's my facts. Well, what happens if A says, I'm going to give you $10,000 cash in the company, and you're going to sell me the land. Proceeds is what, Jameson?
10.
10. Basis?
100.
It's 100. We have the same $90,000 loss that we experienced there. Okay? 267 says that if you sell a property between related parties, or A and the corporation related, A owns 100% of it, you're damn right they're related. So the related party rule says you're not allowed to buy an asset off yourself and generate a loss. You can't do it. But we're going to give you what I'm going to call Jameson relief. We're not going to have disappearing basis in this case. You might, but we have to, Trent, diagnose. There's this concept called floating basis. Which says the $100,000 of basis that existed is a guidepost, a measuring point, something that we can utilize. So we're going to do this under 3 sale scenarios. Okay? How much, Lane, how much did I buy the ground for?
$10.
10,000.
Oh, where?
10K.
What's the 10,000 up there? Or the $10 up there for?
Okay, very precise. Okay, we're going to do this 3 ways. And this is going to demonstrate the concept of floating basis. And 267 is a provision that you should get to know. And I say that with sincerity, as stupid as that sounds. Okay, number 1, number 2, number 3. What the fuck? Proceeds. And this is sale by A after purchase from X. Okay, so A's bought the property from X. So A is now subsequently in the future is going to sell this land. That's what we're talking about. So A made a bad deal, sells it for 8. A made an okay deal and sold it for 60. And A sold the ground for 110. Made a really good deal. Those are our 3 scenarios. What floating basis says is that The basis starts at 10. And then it's going to start floating based on your fact pattern. So if you sell it for less than you actually bought it for, which is scenario 1, you get to use the full 10. And you have a $2,000 loss. The 90 that existed inside the corporation now has disappeared, never to be seen again. Okay? But if we sell it for 60, the basis floats up to 60. You get to harvest the basis that the related party had, and it'll float up from 10 to 60. So now we have no gain or loss. We sell it for 110, we get to harvest all that basis, and it floats up to 100. And you have a $10 gain. So, what in Jameson, in her cry of disappointment, says that we have this disappearing basis. Okay, yeah, we do. I don't like that, Jameson says. Well, let's leverage the rules under 267, and instead of distributing the property, buy it out of the company. And if we buy it out of the company, then we at least get this concept of floating basis that is going to shield the appreciation somewhere between 10 and 100,000 away from taxation because we did it this way. Do you think I've ever done this, Thomas? I have. Anybody else want to bring up any other topics?
So just to clarify, this is only if it's really quick, I swear. Is this only if A purchases the land from X and not if it's a distribution? Correct. Okay.
100%.
Just make sure I'm just
Yep, that's 100% right, Kaylee. Everybody's good? Hey, you're out 5 minutes early.